Okay, 11:02. Good morning again. This is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank in New York, and we welcome you to today's webinar. Today is the first session of our 2021 webinar series. As we did last year, we plan to continue to offer educational sessions to our members to help support your strategies as we continue to work through the ongoing pandemic. We'll bring you these sessions every other Thursday, hosting a range of speakers, both from the FHLBNY and from outside experts, to cover the most important topics of the day. For example, next session, we'll have Carl Nelson, a founder and CEO of KPN Consulting, who will look at the lessons learned in 2020, a year with surprising growth in depository institutions. We know that very well, and how those lessons could be applied for future business. Invitations for that session will go out on Monday, and we'll hope you can join us for that. We believe that this type of engagement, from our webinar series to podcast to the Financial Intelligence Library section of our website, enhances the value of membership to provide you with key information and support to help make the strategic decisions to grow and strengthen your business in this very challenging environment. For example, the Financial Intelligence Library has a wealth of information on LIBOR SOFR transition and how we're helping our members that don't have transition offices set up yet to help you get ready for that. There's information about the Member Service Desk Weekly, which is a newsletter we put out. If you didn't see the news yesterday, we put out a notice to our members. If you do use the FHLBNY for your letters of credit to collateralize your state municipal deposits as another means of elevating value to our members, we gave you a pathway to more dividend income by allowing the B2 capital stock, the activity-based stock, on letters of credit starting on March 1st. So we want to make sure you're well aware of that. Lots of other stuff in the Financial Intelligence Library that we encourage you to take a look at. Throughout the website, there's other stuff, member communications, major events. Next week, we have our board of directors meeting, and I know you're all looking forward to the dividend declaration. We'll be sure to publish that as soon as the board makes that decision. We also provide key information on the launch of our mortgage asset program. If you'd like to learn more about a secondary market outlet, you can schedule a one-on-one with your relationship manager, and we'd be happy to talk to you about that. If you have not yet set up for MAP and you do participate in selling loans to the FHLBNY through the Mortgage Finance Program, MPF, you have very limited time to make that transition. So we encourage you to give us a call so we can make sure you make that transition smoothly, because that too will close at the end of the quarter. So before I hand it over to the next presenter, just a few details about today's webinar. If you have any questions, please submit them at any time through the question box, and they'll be answered at the end of the session, or we've built in some time for Q&A. We're always looking to enhance the program that we offer to you, so we ask you to complete the survey that follows the webinar. The topics and speakers that we select for the sessions come directly from feedback from our members. So anything that you want to talk about or hear about, please let us know, and we'll be sure to put it on the roster for this year. Now I'd like to introduce my friend Tom Citino, Vice President, Director of Member Relations, to kick off the webinar. Tom, take it away.
Thank you, Adam. Good morning, everyone. It's a real pleasure to kick off 2021 webinar series, and then Brian Jones has been a very popular speaker for us throughout 2020. He's been providing valuable insight, especially during this very uncertain time surrounding the COVID crisis. But just a little bit of background regarding Brian Jones. So he's our financial economist. He's been with us 4 years now, and he provides macro and economic analysis and strategic insights for all areas throughout the bank, and also for our membership. Brian's a frequent speaker at our members' board of directors meetings, and then also he's a frequent speaker at the trade. So he speaks at Ibanez, New Jersey Bankers, North Jersey Community Bankers, FMS, and then the credit union leagues as well, New York Credit Union Association and Cross State Credit Union Association. So he's with us on the road, and then we have the pleasure of hearing him speak all the time at all these different events. So Brian's career spans over 3 decades. He comes from a background where I believe he started his economic career at Salomon Brothers, which became Salomon Smith Barney, and Citigroup. He also spent some time at Irving Trust and also Societe Generale. And then, like I had mentioned, he joined the Home Loan Bank 4 years ago, and he's been a great resource for us. His career, his economic analysis largely supported all aspects of fixed income, currencies, and commodities business. With that, I just want to mention if you like Brian, always just reach out to your relationship manager. We would always entertain him speaking at your board of directors meetings or to your management teams and ALCOs. So he's a resource for our members as you're our shareholders. So with that, Brian, I'm going to turn it over to you. Looking forward to your presentation, Turning the Page, the U.S. and Local Economic Outlook.
Okay, good morning, everybody. Let's just dive right into the presentation. As far as the economy is concerned right now, I mean, obviously, in the wake of the pandemic, the United States suffered a very short and very severe downturn in business cycle activity, which was largely attributable to the fact that the economy was essentially just shut down. It was essentially effectively closed beginning in the middle of March, and it didn't start to reopen for over a month's time. Since that point, however, and we can see it in this chart on the left-hand side panel here, the data has generally come in much better than expectations. I mean, clearly the biggest gap versus what people were looking for and what the actual results turned out to be occurred in the middle of last year. But even since that point, as people have, I guess, gotten more and more used to the fact that the downturn ended fairly quickly, the data continues to come in better than the street's looking for by a fairly significant margin. And that's certainly a very hopeful thing going forward. When you do look at individual areas of the economy that are doing better, a lot of key variables are now at levels that exceed their pre-pandemic levels. Whether we look at core retail sales, whether we look at building permits, whether we look at the ISM manufacturing and non-manufacturing surveys, the areas of the economy that are having the toughest time coming back are anything that has to do with labor market conditions. And you can see that in the right-hand side panel on this chart. Basically, non-farm payrolls are still around 5% below where they were before the pandemic struck, as are total hours worked, which is incumbent on the number of people that are out there working. And also industrial production has yet to get back to where it was before the crisis hit, primarily because industrial production is incumbent on how strong the labor inputs are. Turning to the next section of slides, basically where the consensus is now implies that we will probably get the lost output as a result of the pandemic back sometime in the middle of the year. It's probably going to be most likely the spring quarter. To be fair, if you look at the left-hand side panel numbers, the consensus is for a 2.3% increase in GDP in this quarter, followed by 4.1% in the spring, 4.9% in the summer, and then 3.8% in the fall. But, you know, bearing in mind that we've got the likelihood of a fairly substantial fiscal stimulus package coming online, those numbers are probably too low relative to what will eventually print. I mean, there are estimates out there that depending on how quickly the stimulus package gets passed, that we could actually see growth maybe approaching double-digit territory in real GDP during the second quarter of this year, and just a modest pullback over the remaining 6 months. Basically, where the consensus is now is that we should get about a 4% increase in growth over the course of calendar 2021. But if the more optimistic forecasts actually prove to be correct, it could be significantly higher, somewhere near 7.5%. As far as where we were and where we're going, it was a very severe, but it was a very very short downturn. If you look at the chart that I have up here, we've got two recession probability indicators. The first one, the black line, is one that's constructed by the St. Louis Fed, which tries to determine where we are right now in the business cycle. It attempts to replicate the business cycle dating process that the National Bureau of Economic Research goes through. It's based on 4 series: non-farm payrolls, industrial production, real manufacturing and trade sales, and real personal income less transfer payments. And if you look at this measure, as of December, they pegged the probability that we were still in recession at just 0.3%. So we're well out of it. We're a negligible probability we're still in recession at the end of last year. But what's interesting is the 200% readings were in March and April. Those were the 2 months where it was certain that we were in a recession. But after those 2 months, we came back down very quickly as far as whether or not we were in a business cycle downturn. Looking out over the next year, we can use models like the Federal Reserve Bank of New York, which rests on the slope of the yield curve between 10-year notes and 3-month bills. Using the slope where we are right now, the yield curve suggests that the chances that we'll be in a contraction in economic activity at the end of 2021 is just 14.4%. Typically, we need to get up above 35% before we get concerned looking at yield curve-based probability measures. The most important thing, to be fair, for the economy right now is how quickly we get beyond the COVID-19 outbreak. Obviously, the numbers nationwide, and you can see them in the left-hand side panel here, they have been encouraging. While the tests conducted nationwide have started to come down, so have the percentage of positive cases, and they're now below 6%. Typically, where you would like to see that is somewhere near 2.5% at a high before you can more or less declare that the worst is behind your victory in some sense. The encouraging thing is that when you look at our area, as much as it's still front page news and it's on the nightly news every day, there has been a fairly large contraction in the number of positive results, both across New York and New Jersey, since the middle of last month. And if you look at the percentage of positive cases in New York, for example, since the middle of last month, we've fallen by about 2 percentage points to 4.4%. New Jersey, while elevated, has shown similar progress. The percent positive cases in the Guard state has fallen from about 8.6% to 7.3%. So as we continue to see less positive cases, then you will see more removal of social distancing and restrictions, and that'll certainly impact positively the service sectors of the economy. The other thing that we need to be aware of is it's not just the positive cases coming down, but how quickly we can administer the vaccines that have been discovered. These are data through yesterday, and you can see that nationwide, there have been about 44 million doses administered. As far as the percentage of the population, about 10% of the population has gotten the first dose. Just 3.1% have had the second doses. And nationwide, we're administering about 1.5 million COVID vaccine shots every day. For our own district, our results are a little bit below the nationwide average as far as the percent of the population that have gotten shots. New York State, for example, is 9.7, a little bit lower in New Jersey at 9.6. And certainly the other two areas in our coverage area, Puerto Rico and the Virgin Islands, are lagging behind there. But it's basically a dual thing that we have going on here. You want to see the positive cases come down, but you also want to see wider distribution of the vaccine across the population. And you probably won't have the majority of people vaccinated nationwide until probably sometime in the late spring, early summer of this year. Turning to back to the economy out of the medical care realm, what I find more useful to look at right now, because we're trying to get almost an immediate beat on what's going on, is to look at some high frequency economic indicators, and they're mixed. If we look at this set of charts, this is railroad traffic nationwide. Actual car loadings over the latest 6 weeks are running below where they were this time last year, 2020, and also below the level reported in 2019. However, offsetting that is the fact that intermodal traffic across Class A, all the largest railroads in this country, has been actually very robust, and intermodal traffic has actually been above this time over the previous 2 years. So rail traffic, and we can see this in the manufacturing numbers. I mean, those numbers are going to follow the rail traffic numbers fairly closely. And we have seen the manufacturing sector of the economy, both nationally and locally, recover. Other areas are having a tougher time, especially the service sector, service-producing segments of the economy. If we look at the left-hand side panel in this chart, basically what we've got is hotel occupancy rates by week, comparing where we are currently in 2021 to 2020, and what the average, the median had been over the 2 decades ending in 2020. As you can see, we're going into a period of the year in which typically hotel occupancy rates would be rising as business travel picks up as we head into the spring. The question is what sort of a pickup we get over the next several weeks. You know, it would not be surprising to remain below where we normally would be or have been in the past. But the question is, do we get anything that resembles a typical seasonal pickup? And turning to the right-hand side panel, this is another area of the economy that's having a tough time in the current environment. We see that, you know, restaurant usage or the restaurant reservations across a variety of metropolitan areas are well below where they were before the pandemic struck. Turning to the next set of slides, and this basically does a good job in telling you where we stand in stemming this thing. Nationwide, across 10 major metropolitan areas, the number of percentage of people returning to normal office life is just a little bit shy of 24%. But those results vary dramatically across regions in the country. And to be honest, both we and San Francisco are at the low end of that range, although the latest numbers were mixed. The New York metro occupancy rate actually fell in the latest week reported. We're down to just 13.3% of people back to normal office life. San Francisco actually improved a little bit to 12.5%, although in the aggregate they're below us. But you can see that until we get a handle on the pandemic and we have a more widespread distribution of the various vaccines that are currently available, we have a long way to make up to return to normal life within these major metropolitan areas. And you can see that in timely numbers from our own area, with less than 15% of people back in their offices in New York City. Subway usage, the number of people passing through turnstiles every day, has essentially been going sideways at very low levels. You know, fluctuating somewhere around 1 million people per day, whereas before the pandemic struck, we would be averaging on a 7-day basis somewhere around 4 million riders in the New York City subway system. And of course, other areas that require a fair degree of social contact, they're struggling as well. In the left-hand side panel here, we've got air traffic. Certainly, airline usage is way below where we were this time last year, and we're essentially we're below about 40% of last year's ridership on the nation's airlines. And needless to say, and it's probably a function of the fact that there's so much content available online and on stream these days. Movie ticket sales are just a fraction of where they would be this time of year under normal circumstances. Turning to the labor market nationally, labor market conditions have improved. The number of people filing initial jobless claims on a weekly basis have come down substantially. But even with this morning's report in the high 700,000s, we are way above the average in the low 200,000s that we were witnessing before the pandemic hit. And certainly we have a long way to go to get back to normal levels as far as people that are on regular state benefit rolls. These numbers, however, I think give probably too rosy a picture of the improvement in labor market conditions. If you look across all, those numbers were for regular state programs. If you look across all programs now, because again, we've got fairly substantial pandemic-related programs in place, PUA, Pandemic Unemployment Assistance Program, and the Pandemic Emergency Unemployment Compensation Scheme. As of the numbers that came out this morning, there was a big increase of about 2.5 million persons receiving benefits under those two programs. So now the total number of people collecting some sort of unemployment assistance is now over 20 million. So that roughly 11% of the civilian labor force receiving assistance, that was as of last week. That number is going to be higher as of the numbers that were released this morning. As far as the latest job numbers, we had a modest increase in the latest in the month of January, up just 49,000. The encouraging thing there is that we did see some pickup in service-producing employment during the reference period. It was basically a tug of war. We had about 14,000 service-producing jobs there. It also added government jobs, primarily at the state and local educational levels. But if you look at the right-hand side panel, we still have a very long way to go to get back the jobs that we lost as a result of the pandemic. Right now, we've gotten back about 60% of the private jobs that have been lost, and you can see that the areas that are struggling the most are those that require a high degree of social contact, education and health, leisure and hospitality. So it's really the service-producing segment of the economy that we really we're waiting to get back to normal. And that's, again, once we, get more people vaccinated, the percent positive cases come down, and we can return to something that resembles normal life. Turning to the breadth of job gains reported, there was a marked deterioration of the breadth of jobs created across the 278 industries surveyed by the Bureau of Labor Statistics in January. I'm willing to take any 1 month's number with a grain of salt. I mean, these numbers, we're back below the 50% break-even level here. I prefer to look at the 3 or the 6 month diffusion indexes. And although they were lower with the latest report that came out, those numbers are still squarely above the 50-point mark that indicates increased hiring across industries. Turning to the next slide, and we continue to make progress on the unemployment rate, but again, the unemployment rate, regardless of what measure you use, is very elevated. Typically, in the U.S. economy, we consider that unemployment, the full employment in the economy, is somewhere around 4.2%. But even the conventional unemployment rate's running at 6.2%. So we're still 2 full percentage points above that, although we're expected to make significant progress this year on that front. But you can see the extended unemployment rate that includes people that are marginally attached to the labor force and those working part-time for economic reasons. We are still in double-digit territory there. So we've got a considerable way to go as far as the extended unemployment picture is concerned. And that jives with what we saw with the total number of people collecting benefits under various normal and pandemic-related programs. As far as the other side of the Fed's dual mandate, the inflation front, and we are still considerable way from the Fed's desired 2% target on core inflation measures. Currently, core CPI inflation is running about 1.4%. The core PC chain weighted index is apt to print lower when we get the numbers at the end of this month. We will see a pickup in inflation over the next several months, due primarily to what we call base effects. It's the echo of price increases that we had 12 months earlier, and we should hit the 2% mark sometime in the spring. We will probably experience an overshoot during the late spring and summer months. But again, under the Federal Reserve's new operating procedures, they're going to take this thing in stride, any pickup in inflation. Basically, their new view of inflation is that they're not going to react to any immediate move above the 2% desired target level, especially when it comes on the heels of an extended period where we've been running below target. Essentially, what's going on here on the inflation front is the Fed's decided that if inflation's been running slow for a considerable period of time, they're going to let it run hot. Once it does hit the 2% desired target, moves above it, they're not going to slam on the brakes precipitously. because they're basically taking the view that what they're looking at all the time is an average inflation rate. Turning to financial conditions in the U.S. economy are essentially back to where they were before the pandemic struck. Numbers such as the Bloomberg U.S. Financial Conditions Index, they basically came into vogue after the 2008-2009 downturn because it was a financial sector recession and downturn, and basically what conventional economists missed at that point in time was they were pretty accurate on the GDP impact, but they really didn't. They misjudged, I think, badly the impact that tightening financial conditions would have on the overall economy. But you can see that since the worst of the pandemic, we've had a big narrowing in both money market and bond market spreads. We've had improvements, certainly fairly large improvements in the equity market index. If you think about it from the pandemic low, we're up almost 1,500 points on the S&P. And we have had reductions in both fixed income market and in equity market volatility. As far as Federal Reserve policy is concerned, essentially the Fed has told us that they expect to remain on hold for the next 3 years, at least in the forecast horizon we have in what we have here, which is the so-called dot plot. The Fed doesn't envision any change in administered rates through the end of 2023. So basically, you've got the short end of the yield curve anchored by the fact that the Fed doesn't plan on doing anything to move rates. They do, however, continue to believe that the longer run nominal federal funds rate should be somewhere around 2.5% once we get beyond the current period. Looking at the Fed's projections, and you might as well use theirs as much as anybody else's because they're the projections that policy and policy expectations are made on. The Fed continued to boost their estimates of GDP over the course of calendar 2020 to the point where the drag on growth over the course of last calendar year was 2.4%. The Fed right now is expecting about 4.2% growth in calendar 21, followed by a 3.2% increase next year. You can see that in the upper left-hand panel here. That's pretty much in line with consensus. Whether you look at the average of when you look at the average of public and private forecasters, the calendar year increase expected in the current year is about 4%. So the Fed's on track there. As far as unemployment is concerned, and that's in the upper right-hand side panel, the Fed does expect to see further progress over the course of this year. Right now, we're at 6.2% on the unemployment rate as of January. They expect that by Q4, we'll be down to about 5%. And by the final quarter of 2022, we'll be back down to 4.2%, which is essentially what most economists peg as full employment. Turning to inflation, the Federal Reserve right now doesn't expect that they will get back to their PCE target, personal consumption expenditures deflated target, until 2023, and the same on the core rate of inflation. So if you think about it, all of these numbers hang together. We've got GDP to make up. We've got an unemployment rate gap relative to what's considered full employment. And the Fed does not anticipate that inflation is going to get back to their target range on a sustainable basis for the next 3 years. So it makes perfect sense that policy, in their vision, as far as administered rates are concerned, will remain on hold through 2023. Looking at the other side, since the pandemic struck, the Fed's increased their securities holdings, their purchases in the open market, by $2.9 trillion above where we were before the virus struck. About 70% of those purchases have been concentrated in Treasury securities and 30% in mortgage-backed securities. There was some expectation at the end of last year that the Fed might start to taper their securities purchases, but there doesn't seem to be any appetite for that, either in their post-meeting communiques or in their post-meeting press conference by the chairman. Basically, the Fed continues to expect to boost their Treasury holdings, their purchases by about $80 billion per month, and securities purchases and mortgage backs by about $40 billion. Looking at the federal deficit position, I mean, needless to say, in the wake of the pandemic, the deficit has just exploded. In fiscal 2019, we had about $984 billion in red ink at the federal level. In the fiscal year just passed, the deficit just gapped all the way up to a little bit over $3.1 trillion. We're expected to have about a $3.2 trillion deficit in the current fiscal year before we gradually recede over the next several years. By the end of 2024, it should be back down to about 1.4 trillion, which is still well above where we were before the healthcare crisis struck. But you can see in the right-hand side panel here what the result of that is, and that's going to be, we're going to see, ongoing significant increases in Treasury debt issuance and in the percentage of debt that's held by the public. I mean, eventually we're on a track right now that sometime over the next 2 years, the federal debt held by the public is going to be about 100. It's going to be a full year's worth of GDP, 100% of nominal GDP, and we will top out somewhere later in the decade, somewhere at around 108% of GDP on debt held by the public. As far as where interest rate expectations are, I mean, pretty much the consensus is that, and it hasn't changed much, is that basically because the Fed's going to be on hold for the next 3 years, you've got the short end of the Treasury yield curve is basically held constant, with just a marginal pickup in rates anticipated through the spring of next year. But where people do expect where you will see higher rates is in the coupon segment of the Treasury curve out to the spring of 2022. Basically, what you'll see is that you'll see the 30-year bond, if you want to use that as your benchmark, going from about 1.9% this week out to about 2.2%, so about a 30 basis point increase, and pretty much a similar increase in shorter maturity coupons, 5 years and 10-year notes, for example. Look, now shifting our gears to what's going on in our own district. And the data has been very mixed. The manufacturing sector has been expanding for several months now in the New York area, although not at a very rapid clip. Well, we have seen improvements in new orders, improvements in employment, but composite measures that can't kind of mimic what the ISM's Purchasing Managers Index attempts to do. We're running a little bit above the 50% break-even mark. And you can see that in the left-hand side panel on this chart, which has the three diffusion indexes, the composite new orders, and employment. Manufacturers are much more optimistic about what the economy will look like 6 months from now. So, for example, while the current conditions index is somewhere in the low 50s, 6 months ahead, manufacturers expect that the expansion will be significantly wider and faster, with the latest expectations number at about 60. The service sector, however, is it's another ball of wax. The service sector, because of the renewed COVID-19 cases and reimposition of social distancing measures, it continues to struggle mightily in our area. What we have here are data from the New York Fed's Business Leaders Survey on the left-hand side panel. This survey covers not just New York, but also Southern Connecticut and Northern New Jersey. And what you can see in the latest data is that not only did service sector business activity deteriorate in the month of January, but it deteriorated at a faster clip. Layoffs in the service industry picked up during the latest month as well. And even when you look at how businesses assess the climate relative to normal, you're running below 20% on the business climate index. So not only the service sector activity in reality weakening, but relative to where people think it should be, they think the business climate is actually pretty miserable right now. The bright spot, however, is that like manufacturers, service-producing industries in our area do expect things to get better over the next 6 months, and that we will see not only an expansion in activity, by the summer of this year, but also the business climate will have improved substantially. And you can see that in the right-hand side panel in this slide. Looking at digging deeper into what's going on in our own district, the people that are having the toughest time, and we know the service sector is struggling, but really smaller firms in our area are really taking it on the chin. You can see in the left-hand side panel here, these are averages for the country as a whole. The percentage of firms by industry experiencing a large negative impact from the coronavirus. And you can see that the areas of the economy that have the toughest time have been educational services, arts, entertainment, recreation, and accommodations, and food. Now, because we have so much of our economic activity in the Federal Home Loan Bank of New York's coverage area concentrated in those industries, small firms in our area or in our district have suffered to a greater degree than the average nationwide. And you can see that in the right-hand side panel here, where we have the percentages of businesses in our area describing how badly they've been affected by the pandemic. And you can see the percentages experiencing a large negative impact, with the exception of Puerto Rico, are well above the national average. But when we turn to those experiencing a moderate negative impact, that's where Puerto Rico is significantly higher. So in general, the three areas that we do have data on, New York, New Jersey, and Puerto Rico, we don't have figures for the Virgin Islands. Small businesses in our coverage area are having an exceedingly tough time right now. Looking at employment conditions in the district, which includes New York, New Jersey, Puerto Rico, and the Virgin Islands, we have added jobs since May. We've added about 1.4 million jobs in the district. The problem is that we lost almost 2.9 million jobs. We can see that in the left-hand side panel here. So while the nation as a whole has recouped about 57% of all the jobs lost as a result of the healthcare crisis, we're running about 8-9 percentage points below that. And when you look within our coverage area, the area that's fared the best is New Jersey. New Jersey's gotten back about 58% of the jobs lost as a result of the healthcare crisis, followed by New York at about 46%. The two areas that have had an exceedingly tough time have been both Puerto Rico and the Virgin Islands. Puerto Rico's gotten back just 39% of the jobs lost. Virgin Islands, a little less than 7.5%. And you can see what the problem is when you look at the right-hand side panel. When you look at the payroll changes across our district by industry, we have so much activity that's concentrated in the service-producing segments of the economy. So, for example, in professional business services, we've just gotten back 34% of the jobs lost. In education and health, just 40%. And in leisure and hospitality, a little less than 45%. So due to the concentration of jobs, we're having a tough time coming out of this relative to the rest of the nation. And, even though those aggregate numbers are illuminating relative to where we stand compared to the remainder of the nation, it's even more interesting when you get into the detail across segments across the two states and two territories. As you can see, we're running well below the national pace of recovering jobs in the district. But even in New York, where we're running well below, the area that's having the toughest time is the New York City metropolitan area. New York City has gotten back a little over a third of the jobs lost as a result of the pandemic. And you can see other areas that are, obviously have their activity concentrated in service-producing areas. For example, in Puerto Rico, the San Juan area has gotten back just a little bit over a quarter of the jobs lost. New Jersey, however, relative to New York and the other areas, has performed better. There are some areas in New Jersey that have gotten back a substantial portion of the jobs. I mean, the one that stands out, obviously, is Ocean City, where you've gotten about almost 80% of the jobs back, and the Camden metropolitan area, where you've got about 60% of the jobs back. As far as this is the other side of the coin, those are job numbers. When you look at unemployment rates across our district and the nation as a whole, we are lagging in the recovery of in moving our jobless measures lower. Not only has the improvement in unemployment rates across New York, New Jersey, and Puerto Rico been less than the nation as a whole, but our unemployment rates are extremely elevated relative to the remainder of the country. I mean, just to make it comparable, the unemployment rate for the whole U.S. was 6.7% at the end of last year, whereas in our district it was 8.1%. One thing that's going to get has been getting more and more airplay, and it's up to get more and more airplay going forward, is the fact that we have increases in income inequality across not only the nation, but certainly in our area. What this chart shows is what's called the Gini index, and it's a measure of income inequality. A value of 0 would indicate there's perfect equality, everybody's earning the same amount of money, whereas an index level of 1 indicates that basically one person's getting all the money and everybody else is getting 0. But you can see that income inequality, not only in the United States, but in New York and New Jersey, has risen from the latter part of the first decade of this century to the 2014-2018 period. And you can see that the largest increase in income inequality is really in New York. We have a significantly higher Gini index at 51.5% compared to the nationwide average of 48.2. And this is something that we're going to be hearing more and more about, whether it's policymakers in Washington or even monetary policymakers. I think part of the reason why the Fed is willing to allow the economy to run hotter and inflation run hotter into the future is kind of a rising tide lifts all boats mentality, where the Fed thinks that the best thing they can do for the country as a whole and to reduce income inequality is to let the economy run hotter for a prolonged period of time. Turning to the housing sector nationwide, housing's been one of the big bright spots in economic activity over the final half of last year. Supported by low mortgage interest rates, home purchase applications are now back to levels that we last experienced in the middle of the financial crisis in 2008, 2009. And we can see that in the right-hand side panel of this chart, where applications have risen substantially, and they've surged since the end of since the worst of the pandemic in the middle of March. Looking at home sales nationwide seem to have caught up to pending home sales with contract signings. We're just a little bit shy of record high closings across the country, and as encouraging as the numbers were for the U.S. as a whole, the numbers across the Empire and Garden states have been exceptionally impressive, and you can see that in the right-hand side panel on this chart. I mean, pending home sales or contract signings are still running ahead of closings. Basically, in normal times, it takes a month or two to go from a contract signing to a closing. I think because of the pandemic, that time frame has probably been extended to 2 to 3 months in our area. But pending home sales or contract signings are running ahead of closings. And right now, as we were with the latest data, the number of contract signings as of December were almost triple. They're near a record high and triple their pandemic lows that we touched in April. Within our area, I mean, home prices are probably going to remain firm for the considerable future. And part of that is you've got this, at least for homeowners and home sellers, you've got a positive demand-supply dynamic going on. You've got low interest rates pushing demand higher. You've got people leaving the cities for the suburbs as a result of the coronavirus crisis. But the other thing on the supply part of the equation, you can see that in the left-hand side panel in this chart, is in both New York and New Jersey, we continue to get fairly dramatic reductions in the homes available for sale in our area. I mean, for example, in the last year alone, the number of homes on the market in New York and New Jersey fell by almost 31% to a record low 73,500 homes. And as a result, that's been accompanied by sharp increases in median prices across our region. Median prices in New York and New Jersey are up about 20.3% last year, or about $61,000 to a median price a little bit north of $361,000 per home. And you can see that across areas, I mean, the inventory problem has been much more severe in New Jersey than in New York. That's in the left-hand side panel. On the right-hand side panel, you can see as a result of that, median home prices in New Jersey not only have they surged, but they're basically hovering around 375,000, which is well above the average for the two states. Looking at mortgage finance, things continue to improve. Although still elevated in the left-hand side panel, we've got mortgage delinquencies. They have been coming down since the worst of the pandemic, but the number of homes 30 days plus, the number of loans 30 days plus past due at 5.9% as of November. Those are the latest numbers that were released this week. We're still 2 percentage points above where we were this time this year. We have seen some improvements in seriously delinquent loans. Those are 90 or more days past due, but again, we're well above where we were this time last year. And foreclosures, they've been basically holding steady at a level a little bit below where they were in November 2019. On the other side, on the right-hand side panel, you can see the percent of services portfolio volumes that are currently in forbearance. We continue to move lower with total forbearances at about 5.4%. That compares to a pandemic peak of about 8.5%. And the number of people that are in forbearance programs has contracted from about 4.3 million down to 2.7 million homeowners. Looking at the other side of construction side of the economy, there are some signs of life in commercial in business construction. Basically, there's a big pickup in building projects in the beginning of this year. In fact, the number of projects that cost over $100 million came in at about 13, which is above the average, which is a little bit north of 9.5 over the previous 12 months. But what we have seen in the latest data over the last 2 months is there has been a big pickup in commercial construction plans. Basically, the planning numbers lead the actual spending numbers on non-residential investment on structures by about a full year. So we have seen a pickup in plans in business construction plans recently, and again, all of that has been attributable to increased plans for commercial projects. The commercial real estate industry, though, is something that we're going to have to keep an eye on going forward, because it looks like it's going to suffer considerable headwinds over the next several years. And basically, what this slide does is it lists the things that are problematic. I mean, the fact that we put a cap on state and local tax deductions it was placed on our area, put our area at a competitive disadvantage as people and businesses move to lower tax states. The other thing that we have going on in the metropolitan area is that population growth it's not only did it slow, but we've been losing population over the past 2 years. I don't have data in hand for 2020 yet, but my guess is that the trend continued over the last year. A lot of what's going on in the city has been there's financial problems at co-working firms who were the largest commercial consumers of office space in our area. And the other thing too that obviously we all know about now because we're all working remotely is that the ability of firms to operate successfully in a remote posture in the current environment is going to exert a significant downward pressure on the need for office space in the future. And the other thing too is that we have a lot of competitive construction projects that are being conducted in our area, which is going to weigh on the rents that can be charged in existing properties. And that will also result in higher vacancy rates going forward. And with that, I'd be perfectly happy to answer any questions you might have.
Thank you, Brian. We did have a couple of questions. We'll go quick. We're kind of running short of time, Brian, but one just came in, and you kind of mentioned it a little bit here at the end, but what's your outlook for New York City and the office sector? I mean, I'm in the office today right now, only here with a handful of folks, and the neighborhoods are pretty desolate. What do you think is going to happen for this year and next year? And then do you think there's any structural changes that will be taking place?
Well, structural changes thing, let's take that first. I mean, obviously, because so many firms have been successful in operating from a remote posture, chances are there'll be less demand for office space going forward, because I think firms are going to allow people to operate from home or work at home more frequently than they have in the past. So that's a long-term dampener. I think in the near term, the biggest problem we have is that we need to get a handle on stemming the virus, getting everybody inoculated so that we can all get back together again in a safe environment. I mean, if you think about it with those numbers that we had, that we looked at earlier, I mean, the number of people that are back in their offices in New York is just about 13% with the latest figures that came out. We've got a long way to go. I mean, once we do get to the point where people can return to their offices, I mean, there you run the risk that you could have not the risk, you run the chances that you're going to see a big gap upward in economic activity in New York City. Okay, so I mean, basically, the way I would think about this is that you get once we get beyond this point, you're going to see a surge in activity. In consumer spending, restaurant meals, people going to hotels, going to the theater and stuff like that. But other segments like the office space demand segment, that'll settle down over time. That'll be a little bit weaker than it would have been otherwise.
Okay, Brian, thank you. Last question. Just want to get back to inflation again. I know you had some slides in there that inflation was pretty much in check. It would be muted for the next couple of years. The Fed isn't going to planning. The consensus is they're not going to be changing short-term interest rates for 3 years. But with this massive stimulus occurring, and then if there is a pent-up demand, the economy snaps back, how could inflation really stay in check? Do you think that those numbers could kind of change on a dime if we get back online with our economy?
Well, I mean, all things being equal, I think it puts upward pressure on inflation. But how big a snapback you get, I think, is kind of that's the big question. Because I mean, first of all, because we're much more interconnected with the rest of the world these days. I mean, certainly it's very difficult to envision a pickup in goods prices because with inflation worldwide. I think that exerts a dampening impact. The other thing, too, on the service side of the economy is that things have been so weak for so long. I think firms are going to be a little bit reluctant or late in raising their prices. I mean, if you think about it, what's been holding down the core CPI in our country recently has been the fact that airline fares have fallen out of bed. And the question I would have going forward is how quickly do you think the airlines are going to be willing to raise their prices for tickets once demand does come back? Again, the problem with inflation is that we've been fighting this battle for so long. We've been waiting for inflation. And I think the problem that you have is that in order to get a significant higher inflation dynamic going, is you need to impact people's expectations. People have to expect higher prices. And the fact is that right now, inflation expectations remain very well anchored across the economy. So I think unless you get people's perceptions of price increases to change, it's very difficult to get actual prices to go up. Because basically, what people can do is they can just say no. Okay, you want to raise the price of good X? Well, people just say, I'm not going to buy it. I'll pass on it.
Yeah, no, thanks, Brian. It's interesting. So we're going to conclude with that, Brian. Thank you very much. We always appreciate your insights, and the membership, I know, appreciates it. Just as a heads up, once again, like Adam had mentioned earlier, we have another webinar on February 25th. That's going to be conducted by Carl Nelson, titled Our Year of Pandemic, an Industry Review. And Carl's going to examine the community banking sector, how it performed in 2020, lessons learned, how to apply those lessons to 2021 and navigate through some of the persistent headwinds that still exist today. So with that, again, thanks for everyone's attendance. We're going to be sending out a recording and the slides of this to all our attendees. So you'll be getting that as well. So have a great day, and we'll see you in 2 weeks.